Over the years, there are a lot of things one learns from the market. So let us look at some of the learnings from the debt market. One, interest rates can go to zero. This was a very important learning for us, which happened maybe 2008, 2009. The governments of the world did not want the markets to collapse, and therefore they came out with this 0% interest, lending money to people at any rate. And the Americans were worse because they said, and when COVID came, they said, okay, we will give $600 to everybody, whether you are Warren Buffett or whether whoever you are, right, across the board we will give money. So this kind of irresponsible printing of money meant a lot of people had no choice but to keep their money at 0% interest rate. So SV Bank, the Silicon Valley Bank which collapsed, had a lot of money which was at 0% interest, and there is no logic at all for having so much money at 0% interest by very, very rich people. So it comes to the basic saying, why didn't these people wake up? Why didn't they remove their money? I'm not saying they knew SVB was going to collapse, but the fact that you were not getting any interest and huge amounts of money, I mean, I had those figures, I think $80 billion or things like that. Why would so much money be lying in a bank with zero interest? I can still understand a current account. This was just unsecured deposit lying in the bank with 0% interest at a time when treasury had already gone to 4-5%. At least move it to some place. If you don't move it to treasury, move it into a checking account, moving it to a CD, something like that. Why wouldn't people have done that? That was quite a surprising thing. Then realizing that interest rates can move from 0 to 5, or even say 1 to 5, which is a 400% increase within a short span of a year, can completely rip banks apart. Why did this happen? Because in 40 years of its history, SVB never thought interest rates will go up so quick and so fast. Really? Are you kidding? Did you ever think that interest rates will remain at zero? Did you think oil prices will remain at $30? Did you think oil prices will remain at $140? None of these extremes would have worked, right? But when we get something at a particular thing, we get accustomed to it. So if you got accustomed to 5 years of 0% interest, then you think, oh, interest will always be zero. I will always get money at 1%, or I'll get money at 1.15%, things like that. And so therefore people bought big houses, and now they are unable to pay the EMI. There are many people struggling to pay the EMI in US. I think Indian banking was much better handled, or perhaps Indians are far more conservative, whether it's in their banking or whether it's in their personal life. I don't see Indians leveraging the way Americans leverage. Indians don't take so much of educational loans, credit card loans, etc. Yes, it is happening. We are copying the Americans, so we will have a major crisis in credit card debt. And it also reminds me of how our regulator, when the Adani episode happened, he said, I'm going to, the statement issued by RBI was, we are going to get all the details from banks about money lent to Adani Group. Does it really matter that you know that so-and-so bank has lent so much to Adani Group on the basis of shares for which prices have fallen? Should you know it before or should you know it after? Should you be worried that the money lent to a promoter on his own holdings is in a company where the PE ratio is 427? Should you have some kind of caps on that before or after the event happens? So similarly, the Fed had no clue that when they raise interest rates so quickly, which are the banks which would be susceptible to a failure. Did the Fed not have the data? You got to be kidding. Lot of analysts seem to have had the data, and they are putting out reports. It was not their job to put out those reports earlier, but there have been people who had given calls. Fed did not have this data really troubles me, because I got these data from a website, a Wealth of Common Sense, where they say as late as the end of July last year, only half of SVB's US deposits, which were 82 billion, even paid any interest, right? So I said something like 80 billion, this is 82 billion, half of it was without interest. So 41 billion was lying with them without any interest. So didn't the bank think that this money would go out because it's free of interest? So if you are State Bank of India and you have a lot of money in current account, you know that this is spread across so many people. So in one day, they are not going to make the balance zero. Now, if you have deposits lying with you, which is unsecured and zero interest and not even a checking account, why should you assume, why would it be very difficult for somebody to pull out? Does it take too much time to pull out? So people would pull out. So when there was a call saying get get your money out of SVB, there was I mean, obviously there was a run, and the FDIC and Fed had to stand and say, don't worry, we will pay up, because if they had not said that, there was an existential crisis for Fed and FDIC. So here is FDIC, which said, oh, uninsured, insured, doesn't matter, we will protect everybody. US has again said, Yellen has again said that we will protect everybody, and then she said we will not protect, then she said we will protect. Within a week, 3 statements, right? This is not a great situation. So SVB was not looking after its balance sheet properly. The Fed, which had all the data, was not acting on it properly. So RBI, which had all the data about which companies had lent money to Adani Group, or which banks had lent money, they had the data. Their data was lying in different parts of RBI, right? Somebody had sent them a report which was not consolidated, so RBI did not have the consolidated figure of saying this much is the equity capital of Adani, and this much is the market capitalization, this is the PE, and against this they have lent so much money, because ultimately it's a private sector company, right? Adani is a private sector company. However, if LIC holds the shares, if the promoters hold the shares, and loan has been given on the promoters holding, where is the owner's stake in that, right? So that's a question which SEBI and RBI should be asking of every promoter, and long before there is a crisis. So many things that they can do. They have to develop a secondary debt market, so that the people, the promoters are not dependent on banks. They go and raise money in the market. Let them raise 5,000, 10,000, 20,000 crores in the market. Let there be a secondary market. In a secondary market, somebody is continuously assessing the risk that they are taking, right? Another important point which Wealth of Common Sense also says is, just because people have money, it does not mean they know how to manage it. And this is true for, just because a person has got a very big qualification, he's got an IIT and IIM behind it, he's a chartered accountant, does not mean he knows personal finance, does not mean he understands personal finance, does not mean he does this personal finance well, because personal finance is 2 parts. One is the strategy part, which everybody loves to do. How much should be asset allocation? They can read about it for hours on end and talk about it for hours on end. And second is the actual execution, which is the dull, boring part, getting the quarterly statements, making sure that the dividends have come, making, if you have direct equity investor, filing the tax return, writing your account, seeing what return you got on your investment. Nobody wants to do the administrative portion of it, and everybody thinks you buy a software and hey presto, everything would get done. No, just because you have kids, it doesn't mean you know how to bring them up. Just because you have money, it doesn't mean you know how to manage it, right? So SVB is good proof. So many CFOs had kept their money in SVB, which was unsecured and not carrying any interest, and the amount is huge. The percentage of then the amount, the deposits which were uninsured, right? So many new learnings which you have. So why would somebody keep money without earning interest? No idea. Just they got used to the fact that banks don't pay interest, because for a long time Fed had kept the interest rates very low. But when interest rates were going up, you should react, right? If you're a bank, you should react and say, oh, some of my money will go, and secondly, I have to do an MTM of my treasury bills on a day-to-day basis. You cannot say one day I will do, right? So in India, the MTM is much better done. So for private sector banks or public sector banks, I mean, I'm not worried that there will be a run on HDFC Bank or ICICI Bank, which are the so-called private sector banks, because there's no single promoter even in HDFC Bank. So HDFC Bank, ICICI Bank are as much a PSU bank as a SBI, right? So you don't have to worry about those things. The government will step in because they're too big to fail, and also because they put in a lot of controls, much better than what the US has done. So lot of learning. So would you keep your money in treasury bills? Yes. But do treasury bills run this risk of mark-to-market losses? Yes. But don't keep in gilts. Keep in treasury bills. Keep in bills which are 90 days, 180 days, right? So then the risk is less, because the duration is less. So I think a lot of these learnings from SVB, maybe you should make notes and keep it, because the human mind has a tendency to forget it, and the next crisis, when something else happens, we will find that this SVB crisis learning was ignored. So don't do that. Sit and learn. Thank you.